Hello and welcome. Moss Adams is pleased that you've joined us for today's session, How Alternative Investments Affect Tax-Exempt Organizations. Before we begin, I'm going to play our housekeeping video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right. Today's presenters from Moss Adams are Wendy Campos, partner, and Ryan Woods, senior manager. Their bios and contact information are located in your webcast console for your convenience. And now I would like to turn the floor over to Ryan to get the presentation started.
All right. Thank you, Amy. As Amy noted, my name is Ryan Woods. I'm really happy to be with all of you today as we highlight the very exciting topic of alternative investments. We'll kick it off by reviewing our agenda here, high level. As you can see, alternative investments is our main focus. We'll kick it off by going through a high-level overview, including discussing certain risks, benefits, as well as management responsibilities related to alternative investments. Then we'll briefly discuss impacts on audits, as well as audit procedures. Lastly, wrap up with all things tax, where Wendy will walk you through tax impacts and certain things to look out for. Diving in first and foremost, what are alternative investments? Fun fact, alternative investments is such a widely used term, but it's not actually specifically defined in U.S. GAAP. So for purposes of this presentation, we're essentially referencing all investments that are alternative to stocks and bonds, which are actively traded securities. So alternative investments, therefore, more difficult to value, typically no readily determinable fair value. We could truthfully go on and on about different types of alternative investments, as well as different types of legal structures governing these investments, but high level included a few on the slide deck here. The most common types of alternative investments would be your hedge funds or your private equity securities, which are typically set up as limited partnerships. Limited partnerships provide many benefits like the flexibility for general partners, different legal protections, as well as tax efficiency. But alternative investments could also be investments in real estate, either through direct ownership or through LLCs set up as real estate funds or REITs, real estate investment trusts. There are also many other types of alternatives with master funds, feeder funds, commingled funds, offshore funds. A lot of types of investments could be scoped into this category, but much of this content focuses on high level the most common types of alternatives. Organizations thinking about the benefits of alternatives, organizations typically consider investing in alternatives given two main facts. One, there is a lower correlation to traditional asset classes, like your stocks and bonds, which are actively traded, as well as there are potential higher rates of return over time. So this is a great technique to diversify and manage your investment portfolio as well as manage risk. One quick fun fact for the recent Nikubo study of endowments, which is a great annual study. In 2022, participants that took the study reported approximately 58% of their portfolios are allocated to alternative investments. So I think it's a pretty significant amount. All right, with that, we do want to survey the room a bit via our first polling question. So I'll turn the floor back over to you, Amy.
All right, thank you, Ryan. So the first polling question is, how many alternative investment funds do you currently have? And your options are greater than 50 funds, between 10 and 50 funds, fewer than 10 funds, or none. And the polling questions are located right on the slides that we're presenting. So if you can't see it, please just hit the F5 key to refresh your console. All right, we'll leave this up another 5 seconds. Please make sure to hit the submit button once you select your answer. All right, here are the results.
All right. Looks like we have a really, really good mix of folks in the room, with some with a lot of alternative investments, some with none. So I think a really good landscape here. I think hopefully this information will be applicable to the full audience. All right, we spoke very quickly on the benefits. We'd also like to really focus on the risks, because helping balance portfolios, potentially allowing for increased return over time, of course, does not come without some significant risks. So looking at the middle section first, thinking about your investment risks. We can't think about these without alternative investments without some investment risk. There are obviously some complex legal structures, potential exposure to foreign markets, as well as currency volatility. So your investments are potentially subject to unforeseen losses. And also these securities are often highly illiquid, which we'll get into a bit more on how that affects financial reporting. But many private equity securities, for example, do not provide for limited partner-initiated redemptions. Then on the far right side, on the tax and compliance side, there are specific rules and regulations that do come into play, which Wendy will cover in the later slides. So now, lastly, thinking about the accounting and financial reporting side, there is a significant amount of informational risk. Typically, there is a lack of transparency or information available to investment management. Thus, valuations are not easily determinable, and there are significant management estimates that may come into play here. Further, there is typically some lag time in reporting. So potentially your folks with many alternatives, your final valuation may not be available until the end of the following quarter. So your board reporting or your financial close and reporting on investment value may be 1 quarter fully behind. So may affect management as well as investment committee decision making. It's something to be aware of and plan accordingly. Also, many alternatives like private equity securities often only report valuations on a quarterly basis. Thus, if you have a year end for your organization that is not based on typical quarter ends, there may be some benchmarking that will come into play or some additional estimates to ensure you're reporting fair value at your fiscal year end date. Now, thinking about auditing and accounting risk, there are 2 main risks when thinking about alternative investments. That would be the existence as well as evaluation of alternative investments. I would say the most significant risk being valuation. We're not going to get too deep into the fair value methodologies used when valuing alternative investments, but there are many possible methods in determining fair value, which is a few factors that may come into play on the slide deck. And thinking about the fair value hierarchy in your financial reporting, again, these securities typically fall in the level 3 category, or like many hedge funds or private equity securities, could actually be scoped out of your fair value hierarchy and reported at net asset value as a practical expedient. All right, now for entities that may be considering alternative investments, or if you have just a few funds and you're expanding your current alternative, you want to ensure your specific management responsibilities as well as best practices related investment management. So first, just a reminder to everyone on the call, okay, so sorry about my audio for a moment. All right, first, management is fully responsible for the existence and valuation of alternative investments. AICPA and other regulatory agencies are ensuring responsibility cannot be outsourced or assigned to a party outside of management. So if management looks to the fund for valuation, management must also be able to independently evaluate and either accept or challenge the fund manager's valuation procedures. Second, given this responsibility, management must have effective controls and processes related to investment management. Heads up, these controls and processes could significantly impact your work that your auditors will do at year end. So each of these 3 cycles, initial due diligence, ongoing monitoring, and financial reporting controls, are very important to establish a strong control environment at your organization. We're going to take a deep dive into each of these 3 items here on the next few slides. Okay, first, initial due diligence. So prior to choosing to invest in a particular alternative investment, it is crucial to design appropriate controls as well as processes surrounding initial due diligence. I've included several examples here on the slide deck, but essentially there are a variety of approaches and procedures used for organizations in your decision-making process. For organizations with many alternative investments, hopefully there's a very sophisticated, well-established set of policies and procedures that you're using to identify, select, and approve alternative investments, which incorporate certain quantitative, qualitative factors. You'll have dedicated teams managing this whole process, comprehensive due diligence questionnaires managers are filling out, as well as a formal review and approval process of each individual alternative investment. Just for the group, there are certain other organizations that they may rely on third parties to perform pre-investment due diligence, or certain fund of funds may have their own dedicated personnel. But regardless of the approach, the investee organization is still ultimately responsible for performing significant and sufficient due diligence, making informed choices, and lastly, ensuring you're documenting the process. So I can't stress enough how important it is to document your initial due diligence process. Many of my clients have a valuation or due diligence memo for all new securities entered into each year, which typically from an audit perspective would be a key control testing. Also, just noting this information all may seem like a lot, which it is. Organizations do typically spend considerable time or money and resources in performing appropriate due diligence, which may end even in an organization not investing in the underlying security in which much due diligence has been performed. The next major control cycle to talk through today is ongoing monitoring. It's the next step in your due diligence journey. Obviously, you've performed your initial due diligence, you've selected your investment, you've committed capital. Next is your ongoing monitoring controls surrounding all of your investments. Obviously, your entity is monitoring investment results and risk return objectives, but each investor must continue specific due diligence efforts after an investment is made. So one thing to think about is that a very effective ongoing monitoring process requires sufficient information regarding the underlying investee funds or its investments. As we spoke earlier, one of the main risks with these investments is there is a lack of transparency within the fund. So for example, you may not be receiving full detailed listing of all investments in which your fund is investing in, which could make your jobs more complicated when analyzing the valuation used, or applying benchmarks, or comparing to peer groups if you're not having enough transparency on what these underlying investments are. However, there are certain reviewing certain financial statement items or identifying certain benchmarks or comparing to historical returns to monitor your investment portfolio, as well as thinking about, I have a few on the slide here, thinking about your regular meetings with the fund managers, asking for any changes in strategies or positions, key performance drivers, or ask about the change in fund valuation policies or procedures. Lots of different items that you can be asking, inquiring, and then, of course, documenting your monitoring procedures and keeping in your investment files. Reminder, again, good internal controls include a strong documentation related to initial due diligence as well as the ongoing monitoring of each of your individual securities. The next control cycle, which is incredibly important, is of course your financial reporting cycle. These types of controls are very important. First, thinking organizational-wide, organizations should be forming an investment policy to govern your policies, procedures, as well as your risk return objectives, your investment portfolio allocations. Also, you should be forming an investment committee of the board as a best practice. This investment committee would be charged with overseeing, advising, and approving investment decisions, as well as reviewing final valuations annually. Friendly reminder to include some levels of conflict of interest and considerations of conflict of interest in your investment policy or your annual questionnaires given to investment committee members. There are also, of course, many accounting and other financial responsibilities when managing your alternative investment pool, continuously updating investment valuations, continuously analyzing categorization of each investment by type or fair value hierarchy, as well as continuously updating certain benchmarks if applicable, depending on your approach in your final valuation. And of course, you're taking your final listings and you're presenting these information to certain investment committee members to ensure there's sufficient oversight and review of these valuation methods. Now, moving to our next section, we plan to discuss how alternative investments impact your audit procedures. And before we dive in, wanted to push out our next polling question. So Amy, back to you.
All right, thank you. So our second polling question is, from an audit perspective, what risk level are alternative investments typically considered? High risk, moderate risk, low risk, or not risky? And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. All right, a few more seconds. Make sure to hit the submit button. All right, Ryan, here are the results.
All right, thank you, Amy. Obviously, folks in the room are seeing the potential high risk or moderate risk impact on our audit procedures. So I may have also maybe mentioned significant quite a few times throughout this presentation, but I would say there are significant management estimates involved in valuing investments. There's also potential volatility, liquidity concerns. So therefore, we would say alternative investments typically are considered a high-risk account. We'll get more into the risk assessment on this next slide here. So obviously, I am on the assurance side. I work with many clients with certain complex investments, working on auditing and the valuations used each year. So I could talk about how to audit alternative investments, the procedures required, and unique issues we typically encounter. I'll talk about that for hours, but I spared you all with just 2 quick slides, which I think highlight the potential impact on audit procedures. And for many of you who are not auditors, hopefully you'll have some additional perspectives on insights on why auditors are doing what they're doing, and how it is impacting your organization and what your organization is doing, which will impact what the audit team is looking for. So hopping straight in, first and foremost, step 1 is to perform a risk assessment of the investment portfolio. So your audit team will look at materiality of alternative investments compared to your full investment portfolio as a whole, as well as we will look at certain characteristics of alternatives like investment types, the complexities or liquidities, availability of the funds, the higher dollar amount, or the higher the percentage of alternative investments to your total investment portfolio or your total assets, and the greater complexity and volatility of the underlying investments, the higher the risk of material misstatement. And bullet 2 here is very important. We'll be looking at the nature and extent of management's controls and processes. So each control process we already explained: initial due diligence, ongoing monitoring, financial close and reporting. That's essentially your investment management control bucket. This is a very important aspect that your audit team is going to be getting an understanding of. Many potential gaps in controls. For example, the lack of investment policies, the lack of segregation of duties, lack of documented due diligence controls or documented ongoing monitoring, or the lack of your sufficient documentation used in assessing fair value. All of these items could lead to potential significant deficiencies in controls and lead to increased audit risk of material misstatement, as well as increase the amount of testing your audit team will be performing. On the next slide, I want to just talk through the primary audit steps we'll be using when testing alternative investments. I want you to all be aware. First and foremost, again, we'll be definitely focusing on internal control testing. Once we've assessed your systems, we'll be testing to make sure these controls are operating effectively. Next, one of the main procedures we'll be doing is sending confirmations directly to third parties, as well as obtaining financial statements, hopefully from direct third parties or from your management team. These types of procedures, confirmations, and obtaining audited financial statements are typically sufficient for certain limited partnerships or other investments valued at net asset value as a practical expedient. Given our audit team, we can recalculate investment value using confirmed partnership percentages as well as limited partner balances per audited financial statements. However, there are certain organizations with fiscal year ends outside of the calendar year, or your fiscal year end is outside of your alternative investments audited financial statement year end. If those two year ends do not match, there are typically additional procedures your audit team will be performing over rollbacks or roll forwards, assessing certain benchmarking that your management team is using in order to assess and obtain a fair value. So there, obviously, additional procedures then warranted based on the complexity of the valuation. Also with roll forwards or rollbacks, even if the calendar year and the fiscal year do match, standard tie-out type procedures and comparing roll forward items to confirmed roll forwards are typically a pretty standard test you'll see from your audit team. Also do want to note too, if you're using certain custody services, helping to manage and retain your information related to your investment portfolio, the audit team will be reviewing the services applicable, SOC 1 report. We'll be requesting your organization's mapping of the SOC 1 report's complementary user entity controls back over to your organization's control processes. All right, once the testing is wrapped up, these securities do take up quite a bit of real estate, quote unquote, in the financial statements and the notes to the financial statements. So our team will be doing a deep dive on disclosures related to alternative investments. There are also several disclosures in the financial statements related to alternative investments that would be considered particularly sensitive disclosures. Finally, management is responsible, again, for the financial statements and the valuation methodologies, as well as the completeness and accuracy of these disclosures. So all of these items will be included in your final management representation. One additional item to note, these are typically significant risk accounts, so that would lead your audit team to consult with our firm specialists or our technical review teams to help review valuations and identify whether those valuation methodologies are reasonable. And we'll also be bringing in our tax team to review tax positions and ensure these are properly accounted for. And Wendy, I'm not sure if there's any specific tax issues that come to mind when thinking about your role in the audit process.
Yes, Ryan, I just wanted to mention a couple of things in terms of documenting tax positions. Even though your tax-exempt organizations, obviously you could have unrelated business income. That's not uncommon with alternative investments, especially those where you're getting a Schedule K-1 from a real estate fund. Also, we would look at are there any deferred taxes that need to be documented and disclosed. So unrelated business income, we would look at a calculation if there's been UBI in the past, or if you're new into alternatives, if you've got some K-1s already. That usually is the bigger issue, is the lack of information at the time of the financial statement audit, because that information in terms of K-1s is often delayed, just depending on the year end of the fund compared to your year end. But again, a tax provision is an estimate. Materiality comes into play, trivial matters comes into play. So we look at all of those things, but we do need to do some documentation. For private foundations, there definitely would be likely some deferred taxes due to the unrealized gains that usually flow with alternative investments. So there would be a deferred tax consideration as well. And I'll talk more about some of these areas in just a few minutes when we get to the tax areas and focus areas and risks in terms of alternative investments. Thanks, Ryan.
Absolutely. So actually, I'll turn it right back over to you, Wendy, to start taking us through tax issues for alternative investments.
Great. Thank you. We worked that out really well with our slides. We're going to run right into a polling question before I get into our tax issues. So Amy, I will turn it over to you.
All right, thank you, Wendy. So the third polling question is, do you file a 990T for UBI from alternatives? And your options are, we file one every year, we probably should, or never. And also, you do have the option to submit questions for the presenters using the Q&A window. And we do have quite a bit of content to cover. So if we don't have time to respond during the webcast, we will do our best to follow up with you. All right, here are the results.
Great, thank you, Amy. All right, so about 44% file one every year, 46% never, and then a little under 10% probably should with a question mark. Well, hopefully when we talk about tax issues, that'll help you give those that probably should with a question mark. Maybe it'll give you a little more clarity. I'll go into some things in detail. Some will be a little more high level, but it at least gives you, for those of you that aren't into alternatives based on one of the previous polling questions, this is going to give you some good information if you were thinking about, or if your board's thinking about getting into alternative investments. For those of you that have been in them for a while, hopefully you at least, learned something new with the tax issues section. All right. I'm going to spend quite a bit of time on this slide. I want to talk about the reporting issues and areas of exposure from a tax perspective. So keep in mind, a lot of alternative investments that we're seeing our clients invest in are indirect. So those are typically through a partnership. Those are typically your real estate, private equity, fund of funds. Those are common. Partnerships are flow-through entities. You may individually yourself be invested in a partnership. It's the exact same concept. We see a lot of our foundation clients, our higher ed clients, our pension trust clients. Alternatives, as all the reasons Ryan stated early on in his part of the presentation, they're very attractive vehicles from an investment perspective versus just your managed type of investments. So with a flow-through entity, the flow-through characteristics get analyzed just as if the tax-exempt organization is conducting those on their own. So we've got various areas that I want to talk about from an unrelated business income tax perspective, but just keep that in mind, that you're getting a report through the K-1 of your distributive share of income and deduction items, plus a lot of statements. And those statements are important. I mean, the K-1 statements generally have more information that are applicable for tax exempts than the face of the K-1. So don't discount all of those additional pages that come with your K-1s, because those are important, and they're important for your tax advisor as well. We go through those page by page, line by line, looking for any unrelated business income, UBI implications. Are there state filing considerations? Are there required foreign filings? So we're tracking all that activity that's, again, typically in those statements, not on the face of the K-1. There's also direct alternative investments. So those are typically where you would not receive a K-1 from the investment. You're directly investing, and those are typically your offshore funds. So foreign partnerships, foreign corporations. And while there likely would not be UBI implications from those, there certainly could be transfers that need to be considered. So think about when you have a capital call or a contribution that you, the tax exempt, is making to this offshore fund. In the tax world, that's a transfer to a foreign partnership or a foreign corporation. And we have a slide just to talk about all of those potential foreign filings, but I just wanted to kind of give you a preview of more detail we'll go into on some of these areas. So that's important. It's important that you know that your tax advisor know that. It's very challenging to estimate and pay in quarterly estimates when you are heavily invested into alternatives. If you're just into a few alternatives, it's probably not near as challenging. But as you get the bulk of your portfolio, or a large portion of your portfolio is in alternative investments, that information, at least from a tax perspective, you might be getting estimated quarterly income reports or maybe even monthly, but generally that's not going to have unrelated business income that's estimated. You're probably not going to know that until you actually get that K-1. So it makes it really challenging, especially in your first year of being into alternatives, to pay in the necessary amounts for unrelated business income, or to not overpay. So once you're into alternatives for a number of years, you may have years where you're overpaying or underpaying because it's very, very unpredictable when it comes to the tax pieces that you really need to know. For a private foundation, adds even more complexity because you are paying an estimate not only for unrelated business income pieces, but also your net investment income. So your dividends and interest and realized gains that come. So that information you might actually get from your investment manager on a quarterly or monthly basis. That might be helpful in that respect, but we find that there's always seems to be a little bit of continued wiggle room, even with the net investment income. Not near as much as there is with unrelated business income, but just know it's really challenging to calculate your quarterly estimated tax payments each year. We don't have a magic wand that we use for our clients, but generally suggest using best information available. So the K-1s that you've received so far. If you're fortunate enough to get estimated UBI information from any of the funds, that's always helpful. If you've got prior year UBI information, that might be your best information available. And again, that could fluctuate quite a bit from year to year. Same thing with the net investment income, you kind of using those same rules of thumb and best information available. On the Form 990, there is a Schedule F for those of you that are public charities, and then the Form 990-PF, Parts 1 and 9. Those are most heavily impacted when you're into alternative investments. Besides the unrelated business income on a 990-T. And Schedule F is really more disclosure of where you've got investments that are held in a foreign country, for example. The 990-PF, it's a little more impactful because you not only, again, have that net investment income impacts, even for the dividends, the interest, and the realized gains, you've also got to include all of your alternative investments in that calculation for your average fair market value, which determines your payout requirements. So again, having that fair market value, that's usually only something you get once a year at the end of your tax year. But you might be a private foundation that's trying to plan more proactively throughout the year in terms of making your charitable distributions and meeting that payout requirement or meeting a spending policy. And so these are other areas that can be challenging, again, more on the private foundation side because of that, including those values that you may not have until year end or much after year end, frankly, making it just hard to plan for that if you really want to be proactive. Another area I wanted to mention that does make things challenging is the calendar year versus fiscal year investments. And I say K-1s because we usually see it where there's a fund that is, most of them are calendar year. We do come across a number of them that are fiscal year, but more often we see that our tax-exempt organization clients are fiscal year in clients, but the fund they're invested in is a calendar year fund. And so it's tricky, and Ryan alluded to this when he talked about the audit process and procedures. It becomes tricky timing-wise of when you get this information for the tax return, and also what return do you include it in. So the rule of thumb from the IRS is that if you are invested in a fund that is a calendar year fund, so 2022 fund, you get a 2022 Schedule K-1, but you are a fiscal year taxpayer, let's say you're a June 30th taxpayer, you would include the 2022 K-1 in your 2022 tax filing. A 2022 tax filing is when your year begins in 2022. So for, again, a June 30 year end, that's your June 30th, 2023 year-end tax return. So again, it gets, a lot of things to keep track of there and then you just need to be consistent. Once you've started with that new fund, for example, that's a calendar year and you're a fiscal year, you stay consistent. So oftentimes we'll see delays in this information in terms of doing the tax work. So the tax work often has to be extended. Some of our clients don't like that. You don't like to extend. You want to file on time for business reasons, or that's just your preference. Keep in mind, if you aren't into alternatives yet and you're getting into them, this could delay your filings just because of pure lack of information to be able to file complete and accurate returns. All right, I talked a lot already about unrelated business income, UBI, but I wanted to kind of hone in a little more on what generally generates UBI from alternatives. There's generally three ways a partnership can generate unrelated business income. Ordinary income's the most common way. So if you think about a K1, box 1, ordinary income, that's typically operating a trade or business. And usually that's unrelated to an exempt organization's exempt purpose. So examples, working oil and gas interests, timber partnerships, private equity fund investing in a privately owned business. The next most common is debt financed income. And that could be interest income, realized gains from some sort of sale of a debt financed asset, or even dividend income. And then flow through from other investments. So the fund-to-fund arrangement, there could be ordinary or debt financed income flowing up to the partnership that you're actually invested in. All right, I wanted to talk a little bit. Tax reform continues to make things more challenging for tax exempts and more work for sure. But I wanted to talk a little bit about tax reform and partnerships. With tax reform came a provision that unrelated business taxable income needs to be computed and reported for each separate trade or business. So a loss derived from one UBI activity is not permitted against another UBI activity. Net operating loss deductions are permitted only with respect to the trade or business from which the loss arose. There's a transition rule. I'm not going to spend a lot of time on that just because we're past the proposed regulations, but I do want to talk about what constitutes a separate, unrelated activity, which leads us into our next polling question. Amy, I'll turn it over to you.
All right, thank you. So our last polling question is each partnership a separate activity? And your options are yes, it depends, or not sure. And while you're responding, for those of you that would like a copy of today's slides, you can download them from the folder that says slide deck and handout. And then we're also sending them out via email tomorrow along with the recording of this webcast. All right, Wendy, here are the results.
Great, thank you, Amy. So 30% said yes, 55% said it depends, and 15% not sure. Well, this is a great lead-in to the next few slides that I want to talk about. It definitely depends, and we'll talk about what factors can help you determine if it's yes or no, for example. So I'm going to get into the code a little bit here, but I do want to give you the code section. Section 512A6, this is the aggregation rules for investment silos, so those separate activities. All UBI from these sources can be aggregated. Qualified partnership interest, so it meets a de minimis or participation test, and we're going to talk briefly about what that means, or a lower tiered partnership under the look-through rule. S corporation interests, again, that meet that de minimis or participation test, and debt financed income under section 512B4. So just to summarize again, all UBI from these sources, qualified partnership interests, S corps, and debt financed income can be aggregated as one activity. So now it's just determining if they fall into any of those categories. But keep in mind, UBI from Controlled entities cannot be aggregated. And that is, there's a code section 512B13 that says any interest, rents, royalties, or annuities from a controlled entity up to the controlling entity is unrelated business income. So that would be its own silo, its own separate activity. It would not be able to be aggregated into one activity. And then partnerships or S corps that are not qualified. So let's talk about what can cause a partnership to be aggregated because it's a qualified partnership interest, a QPI. So the de minimis test, no more than 2% of the profits interest and no more of 2% of the capital's interest, and not a general partner, and no other ownership evaluation is needed. So a lot of the alternatives will fall into this because alternatives are an investment vehicle for you. They're not a situation where you're actually not investing into an operating business. So you would look at your K1 and see what your profits interest is and your capital's interest and make sure that you're not a general partner. But like I said, generally, we find that a lot of our clients' alternative investment interests do meet the de minimis test. The participation test is another area. So no more than 20% of the capital's interest, including ownership owned by 509(a)(3 supporting organizations and controlled entities. So here you need to take into account some of your possible related entities' ownership as well, if they're also invested in that same fund. Direct partners does not significantly participate in the partnership. So again, you're a passive investor, not an active investor. And again, you're not a general partner. So if you don't meet the de minimis test, then you look to whether you meet the participation test. You don't have to meet both because you wouldn't meet both. You wouldn't look at participation if you already met the de minimis. But if you meet one or the other, it could be considered a qualified partnership interest. And any qualified partner, so if you're in 10 alternatives and all 10 are no more than 2% and meet that de minimis test, then they can all be aggregated as one activity. So if one has a loss and the other has income, they're going to be aggregated as one activity, and that loss can offset the income of the other. And then the look-through test. Directly held partnership does not meet the de minimis or participation test. You could evaluate indirect interests for QPI qualification due to de minimis or participation tests. We don't see that one applied near as often. We usually are looking at whether, one, de minimis test could be met or the participation test. I wanted to give you an example of what your 990T might look like if you've got separate trades or businesses. So activity one, $100,000 of income. Activity two, $50,000 of income. Activity three has a net loss. So you'll see we've got that in a different column. Your two income, you're going to report. Your loss is going to be carried forward, but that loss, keep in mind, can only carry forward for activity three in the future. And then you get to deduct any charitable contributions. The 990C has a specific deduction of $1,000 for all tax-exempt organizations that are required to file to arrive at your net unrelated business taxable income of $147,000. All right, so for those of you that UBI might scare you, or you just think, well, this is kind of a hassle, I don't know about all of this, you'll probably hear investment managers mention blocker corporations. Blocker corporations are separate legal entities. They're typically filing their own return. There's usually not an exception to where they wouldn't, but they're their own separate legal entity. They're filing their own return, and there's usually not UBI to the exempt organization. So you're thinking, oh, this sounds great. And the investment managers often give that impression that this is great because you're not going to have UBI. Keep in mind, though, it doesn't reduce all of the filing considerations that you need to keep in mind. So, for example, foreign filing considerations. You as the tax exempt, if you own 10% or more of this blocker corporation, you may have a more complex foreign filing, and we'll talk about that on a few slides from now on the foreign filings. It also doesn't reduce transfers or filings for transfers to foreign corps and foreign partnerships, because again, you're likely transferring money to this fund as part of your capital call. So you still got some foreign filing considerations. It doesn't do away with those. The state filing, it might be the blocker corp that needs to file those, but depending on your ownership of that blocker corp, you could be the one that's responsible for the administration of this separate legal entity. So keep that in mind. Let me go to the next slide because I do want to talk about states, and then we'll get back into the foreign. So state unrelated business taxable income, best thing we can caution you, stay alert. We are seeing increased state audit activity. States are requiring tax withholding on behalf of your partners. So partners and partnerships, and that includes alternative investments, when you're getting a K-1, you're probably going to get forms that you need to fill out throughout the year that your investment manager is going to say, we're getting you into this fund per your direction, but we need you to fill out this withholding certificate, or are you exempt from withholding? These forms are sometimes complicated. You'll get the same thing for foreign. We get a lot of questions from our clients. I got this form, I don't know how to fill it out, and the investment manager wants it today. Can you help me? We are usually able to help our clients with those, whether it's involving our international group or our knowledge, or collaborating with our state and local tax group to fill out some of these forms that are required. Keep in mind there are 40 states that tax unrelated business income currently. There's only 13 of those 40 that have a distinct Form 990T, if you will. So a separate filing for it's made for a tax-exempt organization that has unrelated business income. The reason that's important is because the states that don't, which are the bulk of them, you're filing the same form a corporation or a trust would file. And it gets very challenging to put tax-exempt organizations into the same box as corporations, taxable corporations and taxable trusts. So just keep that in mind. It just makes it more challenging to complete your compliance filings. There are 12 states that have a minimum tax, so you may have losses in those states, but you're likely going to pay something. And then approximate number of states with a minimum tax payment that range, between $10 and $500 is 9. So in terms of if you got alternatives that are giving you a statement with your K-1 that is giving you, they're typically going to give you a schedule that lists each state and what your UBI sourced income is to that state. So you need to make decisions along with your tax advisor on which states you're actually going to start filing in or not. So in terms of deciding that, looking at the filing threshold for that state, do you have other activity in that state? Do you have property? Whether you own it or rent it? Do you have donors in that state? Do you have employees in that state, even if they're remote employees? And then have you had exposure in previous years, or is this the first year? So how many years do you need to file? After your first state filing, is there any net operating loss available? Have you reported that on a NOL schedule if the state requires it? There's often notices. Again, I talked earlier about the delay in information and hard to estimated tax payments. That is no different for states. So oftentimes you might not even know you should file in a state until you have not extended it, you have not paid any estimates, therefore you're getting late filing or late penalty notices. And again, for these states that don't have separate UBI returns, it gets really challenging because they're requiring, their system is just processing, you didn't put a number on this line. Well, we know that line wasn't applicable because you're not a corporation, a taxable corporation. You're not a taxable trust. But the state system just doesn't really have, a lot of the states just don't have a good system to know, well, this was a tax exempt, so that didn't apply to them. They're going to kick out a notice. So there's a lot of notices and a lot of time that we are seeing either our clients and or collaboratively with us spent on responding to notices. And that's where the hours and volume involved on my last bullet comes into play. Then there's other potential consequences of filing for UBI. Do you need to register in that state? Is there charitable solicitation? And all states are different, so there is not a one-size-fits-all answer to that question. All right, I think this is my last slide, but as promised, I wanted to just touch a little bit more on the foreign filings. So here's the most common foreign filings that we see because of a taxpayer, a tax-exempt in particular, being invested into alternative investments. The Form 926, that's for transfers to foreign corporations. 8865 to a foreign partnership. The 5471, 10% or more stock in a foreign corporation. This is where I caution you if you're encouraged or considering a blocker corporation, all three of these, but in particular the 5471 could come into play where you weren't expecting it. And the other comment I wanted to make on these is oftentimes this is going to require going back to the fund manager, who probably is going to have to go to the tax preparer of the fund to get more information, because oftentimes the K-1 doesn't have quite enough information, and if it's a direct investment where there is no K-1, you're basically going to need to work with or ask your tax advisor and give them permission to work with your investment manager to get some of this information. And some of this information, they even have a really hard time turning around and getting to the tax advisor or to you as our client. So keep that in mind, which again, just a reminder, oftentimes you'll have to extend your returns, not just because you don't have K-1s, but a lot of times it's because you don't have this information to properly complete and accurately complete all the forms that are required. The last two were an 8621 and an 8886. While not quite as common for a tax exempt, they do come up. 8621 is a shareholder of a private foreign investment corporation, so a PFIC. And the penalties for, even though these forms are informational, the penalties for not filing these forms are pretty steep. And if you miss a filing that was required, there's a voluntary compliance program you can go through. It can cause an amended 990T because all of these get attached to your 990T and are e-filed with that 990T, because keep in mind, all those exempt series forms are required to be e-filed at this point. So it's very important that all the information is gathered. As you can tell from both Ryan's portion of this presentation and my portion, investing in alternatives has a lot of positives. Some of the negatives are the additional administrative, both on your side, your audit and tax advisor side, for the audit and tax compliance processes. And obviously with additional time, it does add cost. So you want to think about these types of things if you're not yet into alternatives as, you know, as a factor of getting into them. Again, the return may be high enough that it's still completely worth it, but just keep in mind that you want to know all the information going in. With that, I will turn it back over to Amy.
All right. Well, thank you, Wendy and Ryan, for a great presentation today. And to our audience, if you have further questions or comments, please reach out to us and we would be happy to continue the conversation. You can drop a note in the Q&A window or reach out to Wendy and Ryan directly. Their contact information is in your console. And if you met all CPE requirements, your certificate is available to download now in the CPE progress window. I do want to note that the date is incorrect, so we will be sending out another one via email in the next 2 weeks. And then finally, here is a link to a survey for today's presentation. Your feedback is appreciated, and thank you for joining us. Take care, everyone.